All right. All right. Welcome, everyone. Welcome to the year-end bookkeeping and tax consideration webinar hosted by Common Capital and presented by myself, Katishia Gallishaw. I am the founder and creator of KG Virtual CFO. We offer bookkeeping and accounting services. Common Capital is a small business lending company that just is a great service provider to those in the community. I shared a little bit about my history before the call began with just being able to have access to those funds and also being able to make those services available to their lenders as far as wraparound services and bookkeeping and marketing services to their lenders. They really care about the overall well-being and growth of businesses. So it's great to see you all today, and feel free to chat, drop anything in the chat that you'd like to share about yourself or your business. We had a little bit of conversation earlier, but we'll be monitoring the chat as we go along. Emil also will be available. I believe you all have his email. He'll be sending along the recording of this webinar as well as the slides that I'll be sharing. So that will be made available to you after today's webinar. I wanted to start with a little bit of a value add in terms of current news or current um, tax season information. Just drop a one in the chat if you've already filed your taxes, and then drop a two in the chat if you're like me and you're not quite there yet. You're almost there, but you're not quite there yet in terms of filing your taxes, so I can kind of know where we are. On Wall Street Journal, they offered an article that provided some, as many of you may know, the IRS went through staffing reduction. About 25% or so of their staff have been reduced since last year. And so it's great to have just some kind of boots on the ground tips and tricks that can help you get through this season reasonably painless. This article gives about six tips that I also recommend. It Number one wants to make you aware that customer service delays. The staff is not there like it used to be. The mechanism and the technology is not, ideal in some cases. If you ever been on phone on the customer service line with the IRS and they just hung up on you because they just knew that they weren't going to get to your call. That happens in real life. It's called a courtesy hang up, just so you know that we're not stringing you along. We're not going to get to you, so we're just going to hang up on you. So that is a thing that happens in real life. But as a solution to like any customer service delays or something that can mitigate against that, this article recommends you creating an IRS online account. And so with the IRS online account, I have that also open up on a separate page, irs.gov. You can create your own IRS online account, and also for your individual personal taxes, but also for your business, you can create a business tax account. And with that, you've of course got to verify your identification, but then you'll have access to key tax return information. You'll get access to all those W-2s and 1099s and tax documents that are available under your social security number. You'll have access to any type of refund status and things like that, any notices that you've received from the IRS. You can make payments online through the IRS securely, irs.gov, account online. You can make payments, you can view your balance, manage your profile. So that's a great tip that some people don't, more and more people are becoming aware of and taking advantage of. The IRS allows you to create your own account to have access to your own tax records so that you don't have to call someone or go to a in-person office. Number two talks about ID theft. I mean, we get inundated all the time with spam calls and scammers and things like that. And the IRS is not completely devoid of that. There's been tax returns that have been filed fraudulently and things like that. And so to prevent that, the recommendation here is to create a PIN number. So without that PIN number, your tax preparer or you will not be able to file your tax return. So that will keep your account secure, knowing that someone cannot take your Social Security number and file a tax return on on your behalf.
Okay.
If your line is unmuted, can you please mute your line so that um, it won't be part of the
So
recording?
hang on.
No problem. So that's number two tip. Number three, navigating this new tax law that went into play. You can go on the IRS website. 1040 instructions gives you, there's so many things to take advantage of this new tax law. You can make sure that you have the most information on irs.gov. There's also big backlogs that can happen. And so the IRS, I did also read an article today. Make sure you double check your social security numbers, your name, your addresses, all those things. Double check everything on that tax return before you hit go, because that will keep you from being delayed in getting your return processed. The last two are pretty, straightforward. Please don't file paper returns. If at all possible, please e-file. And then if you're getting a return, make sure you direct deposit because checks are going to delay your refund. Okay? All right. So let's hop into this presentation. If you have any questions, again, you can unmute yourself at this time, or you can put it in the chat and I can try to get to it. Okay. Okay, hold on. Let's share this. Nope. Sorry. We're getting there. Almost there. Apologize for the delay. Here we go. You should see the slides now. You're in Bookkeeping and Tax Considerations, hosted by Common Capital and presented by me. Let's get moving. All right. This information is for presentation purposes only. If you have, a tax specific question for your own personal circumstance or position, make sure you reach out to a qualified advisor. So, do you see the slides? Yes or no? Can someone let me know in the chat if you see the slides? Should be on a disclosure. Okay, Ryan can see them. Awesome. All right, good to go. Thank you, thank you, thank you. All right, so
I
today we
I
have,
still can't see them, Katisha.
say it again.
I said I can't see them. I don't know. Am I missing something?
Okay,
One second.
so others in the chat can see them.
Yeah, that's weird.
I
Hold on.
won- I wonder if you may have to go out and come back in, maybe?
I can do that. I'll be right back in.
Okay, we'll try not to
Okay.
get too far ahead. All right, so big picture game plan today, talking about five steps to make this tax season smoothly. I know some of you have already filed your tax return, but if you're in the midst of it, this can kind of help you get ready. But then if you already filed the tax return, this can help you develop a game plan for each tax season, and it should be able to carry forward each year to make sure that tax season goes nice and smoothly. Ooh, so I like that emoji with the, hands on the temple, kind of like solemn kind of place. We want tax season to be just like that for everyone, except for the tax preparers. We're always going to have a crazy year, but for you all, we want it to be nice, calm, find the center, all that great stuff. So we're going to talk about cleaning up your year-end bookkeeping, running the financial statements, identifying any tax opportunities, checking over some compliance items, and then make sure your tax preparer has everything that they need. Okay, let's go. Tax season, the tax return part of it is really just the final piece of it. It actually starts with bookkeeping and record keeping throughout the year. And if that process has been done throughout the year, tax season would be nice and easy. Clean books, like they used to say, garbage in, garbage out, right? So if you don't have, books that are accurate or accounting records that are accurate, the tax return is not going to be accurate, and that could lead to penalties and things like that. So you want to sort of like today, I'll use a current example, like ChatGPT. What you get from it depends on like your prompt. But if you prompt it and you prime it in the right way and give it right information, then you can have a nice an output that more aligns with what you need, right? So it's kind of you kind of do the work up front, right? And then hopefully on the other end, you'll get some results that are more ideal, right? And even if you haven't filed, we have hopefully we'll give some tips and tricks that can help you along the way and make sure that that process goes smoothly. All right, so let's watch a quick video from the show Schitt's Creek.
What's this? Looks expensive.
This is some new bedding.
David, didn't I just tell you to save your money?
Yeah, I am testing this out for the stores, so work is paying for it.
Work is paying for your bedding?
I was gonna leave, but now I don't want to.
What is that? Is that a new lamp?
Yeah, I'm thinking of bringing homeware into the stores, so that's a write-off.
That's a write-off?
Yeah.
Do you even know what a write-off is?
Yeah, it's when you buy something for your business and the government pays you back for it.
Oh, and who pays for it?
Nobody. You write it off.
Who writes it off?
I don't know. The write-off people. What? Why are we having this conversation?
So if I need booze to get through my day, I can just write that off.
That's a stretch.
But the skincare products you got this morning, those are a write-off.
What skincare products? You purchase skincare products?
Okay. I am the face of the company. If I have acne, what does that say about the legitimacy of the store?
That's not a write-off. That's not a write-off. This? Not a write-off.
Oh, well, the bedding's non-refundable. So,
David, a write-off is a business expense used to reduce your taxable income.
okay. Well, then why isn't it called a tax write-off?
It is. It is. You can't just buy things for yourself and write them off.
Well, then I'll return some things. There's not enough space in here for the massage chair anyway.
I should get back to work, just in case any more of your packages arrive.
Okay, so how many agree with David and how many agree with Dad, right? So, my background is being as a as an IRS auditor, and like that video is so true to life. People just feel like they can write off anything for tax purposes to reduce, of course, their taxable income. But from the IRS rules, the IRS code 162 says business expenses have to be ordinary, necessary, and documented. So they have to be ordinary for your business industry, right? They have to be necessary for your business specifically, and they have to be documented. You can't just, I've seen people writing off, like you said, personal skincare products, gym memberships, family vacations, and all this types of stuff. It has to be a legitimate business expense that's ordinary, necessary, and documented. So let's make sure that those items that are written for tax purposes are comply with the tax code, and that can make tax season go easier. Again, here's our 5 steps. We're going to start out with cleaning up the books. Year-end bookkeeping adjustments. This is what comes first. You have to make sure that the books at the end of the year are reconciled. And we'll talk a little bit about what reconciliation means. We're going to confirm all income is reported, also make sure that all expenses are captured. And for assets, again, assets are items that equipment, computers, vehicles, any type of improvement to your your business location, those are assets. Assets are what the business has purchased or the business has acquired or invested into that has a useful life that extends beyond the current tax year. That's considered an asset. And there's special tax treatment for assets, right? So we're going to make sure that those items are recorded and records are kept so that you can have the most tax advantageous position. As far as the year-end process of reconciliation, reconciliation compares what's in your books. If you have, I don't know if anyone here has an accounting solution like QuickBooks, which is getting very expensive. QuickBooks Online or Wave or FreshBooks, or that's accounting solution. It connects to your business bank account. I see some wave lovers in there. Okay, yeah. So it connects to your business bank account, business credit card account. It downloads all those transactions. You do the accounting in terms of categorizing. Reconciliation compares what's in that accounting solution to what was actually in the bank or credit card, right? If you don't have a digital accounting solution, then you usually have to do something like this by hand or use a spreadsheet or something like that. But in the reconciliation process, you want to make sure that you capture every transaction, find anything that's missing, make sure that's added, and then make sure at the end of the year, your account balances equal what's really happened in real life. As far as hunting down missing items, that could be even, I know as business owners, we want to first establish that we have a business bank account separate in the business name, right? You have a business EIN, you have your business founding documents, you go to the bank, you open up an account. If you want to establish business credit, you make sure that the business has its own credit card account. So those are business accounts. And you want to make sure all your business transactions funnel through those accounts, right? That keeps your business transactions separate from your personal transactions. But sometimes in the beginning, as often some of you said that you're starting up, you're in a startup phase, sometimes we have to use our personal funds to pay for legitimate, ordinary, and necessary business expenses. In that case, you want to be able to document those items that you paid on your business credit card or debit card, and you want to be able to import those into your business records so that everything is all in one place. And usually, if you have my clients have an accounting solution like Wave or QuickBooks Online, I create a spreadsheet with all of those items that need to be imported. And then we bring them into the accounting solution. We can import them and then make sure that they're all in the business book so that when we run the final reports, everything is in one place. So we want to make sure everything that happened in your business in that year or your organization, because there may be some nonprofits out there, we want to make sure everything that happened during that year is part of that current year's financial statements, right? If you have something like a QuickBooks or similar to a Wave, there is a reconciliation process. Again, comparing what's in the accounting solution to what actually happened in real life. And so we're going to play just a little bit of this video to show about the reconciliation process. And we'll talk about it later.
Reconciling is an important step in managing your business. Let's go over what it is, what you should do before you reconcile, and then how to reconcile in QuickBooks. When you reconcile, you make sure that the records that you keep in QuickBooks match your bank and credit card statements. First, make sure that you have accurate records in QuickBooks. Record all your money coming in for the month and all your money going out for the month in QuickBooks. Connecting your bank and credit card accounts to QuickBooks and then categorizing all those transactions is the fastest and best way to keep your books accurate. If you want help learning how to connect to online banking and how to categorize your transactions, then there are videos at the end of this one that can teach you how. It's best to do this process every month after you get your statement from the bank. You'll need your statement to match the bank's records to QuickBooks, so have it handy. There are two different reconciliation experiences in QuickBooks, our classic workflow and an AI-powered version. Check our plans and pricing page to see which features are included in your plan. Let's start with the classic workflow. If you have the AI-powered reconciliation experience, you can skip ahead to see that version. Once you're ready to reconcile, go to Settings, then Reconcile. Choose the bank or credit card account you want to reconcile. Enter in the ending balance and the ending date from the bank or credit card statement you received. Double check that your opening balance matches your statement. If everything looks good, select Start Reconciling. Now take your bank statement and compare that to the information in QuickBooks, especially the dates and amounts. Find an item in your statement and then find it here. If they match, then put a check mark next to it. If you see an item in your reconcile list that is not on your statement, then don't check it. If you have your account connected to QuickBooks, you'll see many transactions with a check next to them. These items have already been cleared when QuickBooks downloaded the item and you matched it in QuickBooks when you reviewed your transaction fee. So no need to worry about these. Once you verify all items from your statement in QuickBooks, you should have a zero balance. That tells you that there is zero difference between what's in QuickBooks and what's on the bank statement. If you have a difference, then you'll see the amount here, and you'll need to figure out why. First, select Edit Info and verify that your beginning balance, and ending date are all correct. If they are, go back and check any transactions that you manually entered into QuickBooks. So any item that didn't already have a check mark next to it when you started, and see if you can find the error. You can select any item for more details, and if you need to make a change, you can enter it and save. If you cannot find the error, you can still choose to finish and accept the difference. QuickBooks will create a journal entry that adjusts your books by the amount of the difference. However, you should talk to your accountant before doing this. Usually, it's best to resolve any differences in reconciliation and to not perform this task. Once you've reached a difference of zero, select Finish Now, and then Done. You can look at a detailed history of your reconciliations at any time by clicking History by Account. Now, let's take a look at the AI-powered reconciliation experience.
Let's not. All right. I'm not a huge fan of the AI process in QuickBooks, but again, just by way of review, reconciliation compares what's in your accounting solution to what happened in real life. And what you need for the reconciliation process is that ending date of the statement that you're looking at that particular month, and you need the ending balance. And then magically they do the little work and make sure that those items match. And this reconciliation process helps to find any errors, any omissions, any duplicates. It must be done at least annually, but hopefully you're doing it monthly or quarterly. All right. Any questions on that reconciliation process? All right, cool. We're still in step one, talking about getting our year-end books in place. We want to make sure, as far as in this process, we want to not only reconcile, but we want to make sure that we didn't miss anything that should be reported as income. So oftentimes you'll receive 1099s from any vendors that you've done business with, or if you've used any payment processors and you've reached a certain threshold, then you'll get a 1099K from them. You want to make sure that all income from wherever sources that you have collected it is reported. If you use something like a Stripe, a Square, or PayPal, or Venmo business, you want to make sure all that income is reported in your end of year statements. Something to note is that 1099 that you get from Stripe or Square or any other payment processor, that's going to give the gross amount of the revenue that you received through that payment processor. As we know, these payment processors typically take somewhere about 3%, more or less, depending on the type of transaction and kind of where you are. It's going to report the gross amount, but those fees, those merchant fees and those processors fees, those are, as we say, ordinary necessary business expenses. So you want to make sure that that expense from those payment processors is captured some way, and that you report the income, gross income, yes, but then you also report the expense that relates to that, right? Also, those 1099s could have errors. They don't often subtract any type of refunds or disputes or things like that. So you want to make sure that you've done a reconciliation of that process. Also, oftentimes the processor, I know PayPal, you can run like an annual summary or annual report of all the transactions. So you want to make sure that you don't over-report the income or under-report. You want to make sure that you're reporting things properly, right? And if you ever feel that you've received a 1099 and shouldn't have, there is a process for fighting that or disputing that, right? That was the income side. On the expense side, you want to make sure that, if you're doing this on your own using Wave or QuickBooks, FreshBooks, or something like that, you want to make sure that there's not any uncategorized transactions. That's not a thing, right? So, I mean, it's a thing that's in QuickBooks, but as a deduction, you can't deduct uncategorized expense, right? It has to be named. What exactly is it? So you want to trace down what it is and make sure that you give it the proper category. Make sure your expenses aren't duplicated. Oftentimes this happens like within the system, you can create a bill. So say if you received a bill from a vendor, right? And it's not payable, maybe it's payable 15 or 30 days. And so you put it in your accounting software just to record that you have an accounts payable that's coming up, right? But then when you pay it, you have to make sure when it comes from the bank account that you match that to the bill that you have recorded in QuickBooks or Wave or whatever your accounting solution is. You want to make sure that you match that withdrawal to that bill so that you're not double deducting expenses. Same thing on the income side. If you use your accounting solution for invoicing and you send it to clients, you want to make sure when they pay you that you match that deposit to that invoice that you sent them so that you're not double counting income and overstating income, right? Just some little tips and tricks to make sure that your books are as accurate as possible. Make sure no personal purchases are in the account. And then also make sure if you're in the type of business that collects sales or meals tax, that's not income. It's something that comes through and deposits into your account, but it's actually a liability because you actually owe Massachusetts or whatever the state that you've collected that sales or meals tax on behalf of, you actually owe that and you file those returns and make sure that that is remitted to the state. So you don't want to record that sales tax as income. You want to make sure that's recorded as a liability. And if you have a point of sale system, something like a Square or a Stripe, and if you can integrate that with QuickBooks or Wave, then usually that'll allow for that information to be captured so that it's not reported as income, it's actually reported as a liability. But if you don't have that type of sophisticated system or things like that, you want to make sure that you report that separately so that you're not over reporting income, sales taxes income, right? Also, other things that are not income, any money you personally invest in the business, that's not income. That goes on the balance sheet. That's an owner's investment. Any loans, if you have a relationship with Common Capital or any other lending institution, a line of credit, and they advance you funds, that's not income, right? That's a liability. So you should report that as you don't want to pay taxes on that. You received a $50,000 or $100,000 loan. You don't want to pay taxes on that as if that's a sale. You want to make sure that's properly recorded on that balance sheet so that that's a liability and not income. Income is what you pay taxes on, right? Expenses is what's a deduction from your income so that the net profit is the bottom line that is taxable for income tax purposes. So those are some common financial cleanup items on the expense side, and we talked about the income side earlier. All right, so that's step number one, clean up the books. Again, questions, chime on in or in the chat. I'm going to pause, and then now we're going to go into reviewing the financials, step two, namely the profit and loss and the balance sheet. All right, here we go. How to review the balance sheet. We're going to look at the profit and loss and the balance sheet. Once your books are clean, now you can run these financial statements. Now you can look at these financial statements, and these financial statements are the most powerful tool your business has, right? So they tell you what's actually going on in real time. So that's why, I'm a big champion, not only for job security, but I'm a champion for like ongoing bookkeeping services, or even if you do it yourself, because that lets you know what's happening in real time and lets you know the health and well-being of your business. You can feel and look at the cash balance and feel a certain way about it. All right, but the numbers give you like a little distance, it's like your, non-emotional friend, right? It gives you like a non-emotional part or objective view of actually what's going on. Profit and loss, or P&L, lets you know the income that you've earned minus your expenses for the year. This is what you actually pay taxes on. Balance sheet shows your assets, what the business owns, right? Your liabilities, what the business owes, any creditors or things like that. And the equity is what you've personally invested in the business and taken out as owner's draw. These are the financial statements that your CPA, enrolled agent, or tax preparer, or you, if you're doing it yourself, these are what you need for to prepare your tax return. Let's go into it a little bit deeper. On the P&L, here are 5 questions that I typically ask. Is revenue complete? Look at it. If I know some of us are startups here, but if you've been in business for more than a year, it's good to compare from year to year. Does that revenue number seem reasonable when compared to last year? Or does it seem a little off? Is there anything that could be recorded in revenue that's not there or that may be missing, right? And if you really want to get snazzy, you can look at it month to month and see where your seasonality of your business could be. Summer may be your big months for sales, or, if you're landscaping, you're going to have a big amount of revenue during the summer months, and then the winter months, unless you kind of doing something else with your business, that may be a dip, right? So look at that revenue, see if you can see the seasonality, or a bare minimum, compare it to last year and see if anything looks off. Also on the expense side, anything looks high, low. You look at your P&L and say, wait a minute, why is marketing so high? And then you remember, oh man, you know what? I got a website redesign. That's marketing. Or I've ran some Facebook ads, and that was a marketing investment. And so the numbers are objective, right? But then you give that story behind the numbers. Then you be able to understand what's happening in your business, and be able to provide that narrative behind the numbers and help know and understand for yourself how your business is operating, and use those financials to make business decisions, hopefully. But then at the bare minimum, if your CPA or accountant, someone asks why this number seems off, you're able to already have that narrative as to why things are different from the year before. If you're claiming anything like meals, travel, auto, make sure that you have document. These items are heavily scrutinized oftentimes by the IRS. And if you've paid contractors, make sure you've issued 1099s. If you paid contractors over $600 in 2025, that number is going to go up to 2,000, I believe. In 2026, you paid another person or business for services rendered over that amount, over that threshold amount. And if they're not a corporation, then you're obligated to issue them a 1099 by January 31st, right? And then lastly, the question that I asked, like, do you have anything in miscellaneous? And if not, we have to be able to explain that, right? Because again, those items are heavily scrutinized. 5 P&L questions that we have here. And you'll have these slides if you need to go back for information purposes. On the balance sheet, we talked about reconciliation, the bank, the credit card, but also make sure that you reconcile your loan and financing if that applies to you. Your lender should provide you a statement at the end of the year and let you know what that loan balance is as of 12/31. You compare that to the balance sheet in your books and make sure that those items match. If they don't, did you properly record interest versus principal? Because remember, or if you don't know, interest goes on the profit and loss statement, but we said the loan proceeds is not taxable, but it goes as a liability. And as you pay down the principal portion of that loan, that stays on your balance sheet. So when you get that end of year lender statement, you want to make sure that what's on your balance sheet reconciles to what the lenders have, and make sure that the principal and the interest has been reported properly. Usually your accounting solution will have something like a split so that you can split the transactions. Make sure owner's draw. Another big, if you're a single member LLC, sole proprietor, when you pay yourself, that's an owner's draw. That's not a wage. So owner's draw goes on the balance sheet, doesn't go on the income statement. So that's not going to affect your profit and loss if you take an owner's draw, or again, as you contribute money, that's going to go on your balance sheet. Make sure your owner's draw, if you're a single member LLC or sole proprietor, make sure that goes on the balance sheet, not the profit and loss statement. That's financial statements. That's step number 2. We're moving right along. One thing that I like to remind folks is that revenue does not equal profit, does not equals cash. So revenue is that gross revenue, the money that you got in from sales. Profit is minus expenses. That's what you actually pay taxes on, and cash is in the bank, right? Step number 2 was review financial statements. Step number 3, let's look at some tax opportunities. Some common tax season mistakes: waiting until tax season, look at the books, relying on that bank balance instead of using your actual financial statements, missing income from payment processors, mixing business and personal, that's another mistake, not tracking your asset purchases. Make sure that you have everything you need. We'll get into that a little bit further along in the presentation. Ignoring estimated tax payments. If you're a profitable business and you've paid taxes last year, you're going to usually owe estimated taxes this year. So you want to make sure that those are reported. We'll talk about that again a little bit further along. And then failing to provide your tax preparer everything that you receive in terms of tax documents. It's important to know that the IRS has a matching software. So every 1099 that you've received under your Social Security number or EIN, they're going to look to that tax return and see if that is reported as income. It's the easiest, lightest lift that they can ever employ in terms of the strategy to make sure that you've reported all your income. There's a simple software that runs every 1099 and make sure that that's properly reported. If it's not reported, you're gonna get a letter, right? And say that you have not reported income, report this income, right? So make sure your accountant or your tax preparer has those documents to make sure that everything is prepared appropriately. We're going to talk about some tax opportunities that will include, accelerated tax deductions for assets, also some retirement contributions, and we're going to make sure that we get tax advice as needed. On the asset side, if you purchase an asset, something, again, that has a useful life of more than the year, something like an auto, something like equipment, something like improvements to your space, you have a choice on whether you deduct that in 1 year or depreciate it over a number of years. Usually the default position is to depreciate it and take a portion over that each year, right? But the tax law usually has, and this is no different than this tax year, there's either Section 179 deduction that can take it all in 1 year, or bonus depreciation deduction. Similarly, this year it's 100%, right? So should you take advantage of that? That depends on your independent tax position, right? So if you are not profitable that year, so say if you're operating this year at a loss and in the future you expect to have income, it might be better to not take it all in 1 year, take that deduction all in 1 year. It might be better to spread that year by year using depreciation, because if you take an accelerated deduction this year, it's just going to increase your loss, and that may not really help your tax position anymore, right? But if you depreciate it and next year you have income to offset that deduction, it could help your tax position in the future. So whether you use these accelerated depreciation methods really depends on your tax position, but it's good to know that you have that information. So if you've purchased any asset throughout the year, make sure it's documented and make sure you share that information with your tax professional so that it's properly reported in the way that's most tax advantageous to you. Make sure that you have the proper records. We talked about records. You need the item description and cost, the purchase date, and in-service date. So those are two distinct dates. The purchase date is, of course, the day that you bought it, right? Whether you paid cash for it or you financed it, right? That doesn't matter. It's the day that you purchased it. Usually you can see that on the invoice. But the in-service date is the day that you actually started using it for business purposes. And usually that's the date that you can start depreciating it. So make sure that you have those dates in mind as far as that distinction. Know how it was paid. And for vehicles, you have to have extra records such as mileage logs and things like that, and receipts. So make sure you have the records that you need for that. Quickly, we'll touch on retirement contributions. That's another way that your future self will thank you, right? So if you contribute to an IRA account for a self-employment person or solo 401k, if you're a W-2 wage earner, you usually have, your employer has its own retirement savings mechanism, right? Hopefully, right? But if you're self-employed, then you're responsible for saving for retirement yourself. So you can create either a SEP IRA, solo IRA, there's a simple IRA, there's other options. And this is a way that you can take advantage of contributing to these and lower your taxes, but also save for retirement. And depending on what you choose, you can either contribute after, so say if it's for 2025, you can contribute up until the filing date of your 2026, and it can still impact your 2025 return, right? So make sure that you know what, what type of retirement account you want to use, and what your contribution limits are, and then when that retirement account has to be established. Would paying for IRA replace obligation for Social Security, or is Social Security optional when self-employed business owners? That's a great question. So, as a self-employed person, you don't, of course, you don't have a W-2, right, that withholds that FICA and Medicare. But what does happen is that you pay, which is called self-employment tax. So on that net income of your business and your profit and loss, you pay self-employment tax, which is 15.3% of your net income, and that is contributed into the Social Security system for the self-employment person. So the self-employment taxes that you pay on your taxes relative to your business income is a contribution into Social Security. Hopefully that's going to be around when we all retire, right? But if not, and if you want to supplement your future self, these are also some retirement contribution options that you can employ. All right, that answered your question. Awesome. All right, so we talked about cleaning up books, we talked about financials, talked about tax opportunities. We're going to talk about compliance, and then we're going to let you go, right? Estimated taxes. We just talked about this a little bit about, the self-employment tax that's relative to self-employed persons, right? That's usually split up. The tax is split up between 4 quarterly payments, and that is paid to the IRS. You can use that. Remember that account that we talked about at the beginning, that IRS account? You can use that system to pay into your quarterly payments. These are the typical dates. The 15th, April 15th is usually for Q1 income, and so on. And that April 15th is usually for the last quarter of the prior year. So that timing is important. So if you pay April 15th of this year, that's relative to last year's quarterly payment. So you have to make sure that there's a proper matching there. And if you don't pay enough estimated taxes, if you're profitable and you don't pay enough taxes, then there is an underpayment penalty. So to avoid that, you want to make sure that you pay at least 100% of last year's tax liability, or at least 90% of the current year tax liability. How would I know that? Run financial statements for your business and make sure that you're on track for that. Also, when your tax preparer, or when you, like, say, use TurboTax or what have you, and you owed tax for last year, what it usually do is give you a quarterly payment coupon, right? Like a 1040 dash, was it PD? Some kind of coupon that shows you what your quarterly payments should be and the dates that you should pay them. Usually something like a TurboTax or those accounting softwares will spit that out for you so that you'll be on track with that. Hands down, the most consequential decision for that relates to taxes is your entity structure, whether you're a sole proprietor, single member LLC. This, we talked about this a little bit earlier, was the SE tax, 15.3% of your net income, plus you pay income tax. S corporations don't have that additional layer of taxes. They only pay SE taxes that you pay on your wage. So, as a sole proprietor, a single member LLC, you take owner's draw. But when you become an S corporation, you pay yourself a wage, a reasonable wage. And then now, whereas your owner's draw wasn't deductible on your profit and loss, as an S corporation employee, your wages are deductible from your on your profit and loss. And your business pays that half of your SE tax for you, right? But not everybody should be an S corporation. Talks to your tax professional to see at which income level or net income level makes the most sense for you. And if you started your business as an LLC and you want to file an election to be treated as an S corporation, that deadline is March 15th of every year. Again, talks to your professional, tax professional, but it can be a tax savings mechanisms to switch from a single member or sole proprietor to an S corporation, but it has to be at the right time, right? At the right levels. And there is an extra layer of compliance risk in terms of you have to put yourself on payroll and things like that. But from a tax perspective, it can save you money. Is that March timing for the prior year or for the current year? You want to have that filed by March 15th for the current year, right? And so this whole year you can be treated as an S corporation. If you want to be treated as an S corporation for the prior year, talk to your tax professional because you can file an application and say that there's a reason why, we filed this late, and you have to make sure that the payments that you paid yourself via owner's draw, you have to make sure that is converted into a wage and you pay payroll taxes and things like that. It can be done late, but it takes some extra maneuvering. Typically each year hopefully that answers your question. Typically, each year, the W-2s and 1099s must be submitted by January 31st. Make sure employees and contractors are properly classified. And if it's a 1099 contractor, you want to make sure that you submit the 1099. 600 for 2025, 2026, that amount's going up to 2,000. We don't know what it's going to be in the future. And if you know that you're paying someone, a contractor, and you know that you're going to have to issue them a 1099, have them complete Form W-9, right? Have them complete it in advance. It's kind of, it can be kind of awkward if after the fact you say, hey, listen, I'm going to have to issue a 1099. Can you complete that W-9 so I can have your tax information, right? You want to make sure that you do that ahead of time so everything is up front, and then come tax time, there's no delay. You can file the necessary forms. Okay, so we talked about cleaning up books, we talked about reviewing financials, we talked about tax opportunities and compliance risks. This kind of buttons it all up. Make sure that you've gathered your financial statements, credit card, bank activity, any assets that you purchased, any contractor or employee documents and payroll documents. Make sure you have that. Anything that happened unusual this year, make sure that that's documented, and make sure that you pass this along to your accounting professional, or make sure you have it handy if you are preparing the tax return yourself. Is this for personal and business? Step 5, accounting package. This is more so for business. For personal, I can send as with the slides, I can also send a checklist of the tax documents that you should have at a comprehensive level for your personal and your business. There's any number of forms. You might need your mortgage statement if you own your home. You need your health insurance statement for any health insurance. You're gonna need, if you this year you can deduct auto loan interest. So you need those statements. You need charitable contribution statements. You need medical. There's so many documents that you need relative to the personal. But this presentation is specifically for business owners, and I can send an addendum with some items that to look out for on the personal side as well. And Emil should be able to send that out to you with the recording if needed. Hopefully that answers your question. 10-point checklist just as review. And again, get ready for if you have any questions, you can unmute yourself or drop it in the chat. Reconcile your accounts, reconcile your bank accounts, reconcile your credit card accounts. Make sure all revenue is reported, all expenses are reported. Make sure you separate business and personal. Make sure you record assets properly. Review that P&L, review that balance sheet. Anything seems funky, make sure you have an explanation for it or correct it before you give it to your tax professional. Make sure that you're compliant with payroll and 1099 filings and compile those documents and give it to your tax professional. Questions, comments, anything that we have?
Thank you so
Again,
much for making this like easy to understand because
oh,
taxes and these kind of things can be um very challenging, but you've explained it in a way where it's easy to follow along. So thank you so much for that.
my pleasure. Thank you. My pleasure. Any other questions, comments? I'm going to make sure Emil has the recording, make sure he has the slides. I'm also going to give you some a checklist for personal tax documents and business tax documents. I'm also going to give you like this tax year with that bill, that tax bill. There's so many things to take into account. I'm going to give you kind of a one pager that can kind of incorporate that as well so that you can think of. And those links that we talked about in the beginning about setting up an IRS account and kind of some things that you can do to kind of prevent this crazy tax season kind of IRS backlog that I suspect is going to happen, right?
And is it, can we reach out to you in any way, shape, or form, or do you take new clients? How do you handle that?
Absolutely. Yeah. My business is KG Virtual CFO. So kgvirtualcfo.com. Reach out to me. There's a form on the site because there's so much spam. There's like a form, and then I have to make sure you're a real person and then send you a link. But yeah, reach out on the website or my email address is info@kgvirtualcfo.com. I'll be happy to chat with you.
Great.
I have a quick question.
Sure.
If there's a shift in uh, who has been managing the books, like they've left quickly and now there are things on the books that one doesn't know. How do you recommend kind of navigating things that remain question marks?
Yeah, I mean, that reconciliation process compares what happened on the statements to what happened within the books. So that should help you to discover anything that may have been recorded that was wrong, or if anything that may be missing. So make sure that the books are reconciled at the end of the year, and then look at your financials, and then see if anything is not explained. Make sure that you can if you got a accounting solution, do you use like QuickBooks or Wave or something like that?
Yes, QuickBooks.
So if you go into QuickBooks, any line item that you want to see the detail on, you can click on that in the reports and you can see every transaction that was reported under that particular category. And that can tell you the detail of what's there. So nothing can be like made up, right? And if it doesn't make sense, if somebody added something that shouldn't be there, you can remove it. That's a place that I would start with. Does that kind of answer your question, or is there something specific that
Yeah,
you think?
no, that's helpful. I think it's I'm thinking about like categorizing and it's like I don't know what category this is because I don't know what it was. Um,
Okay. Yeah, and that's kind of like a work like the categorization goes on your chart of accounts, and that's basically by whoever's doing it. It's based by their, their professional judgment, right? And so if you, like I said, if you go like on a profit and loss and you see an amount, you can click on it and see the date and the bank transaction and what specific bank transaction that is, and see if that jogs your memory. And I purchased this at this particular date from this particular vendor, and see if that can kind of jog your mind as to what it is and see if it's properly categorized or not. Um, that's the only way that you can drill down and see what happened, what somebody else did versus kind of what happened in real life.
thank you.
Yeah. Yeah. But generally, you just want to make sure everything is there, right? If it's in the wrong bucket, that's something that can be fixed. So, if you call something office and it should be advertising, that's, you know, not right, but at least you're taking that deduction, and that's better than missing something completely. So having something in the wrong bucket is not great, but at least it's there, right? You want to make sure that everything that you did during the year is actually there somewhere, right? You can reclassify things as needed. Sure thing. Awesome. Awesome. All right, it's been my absolute joy and pleasure to be with you all today. Expect an email from Emil, and we're sending kind thoughts to him as he's mourning for a lost friend. But great to be with you. If you need me specifically, you can reach out to my business or reach out to Emil, and he knows how to get out to me, get in touch with me. Glad to be with you all today. Take care.